All right, welcome to Talker Tickers, where we dig into the story behind the stock. Today, we've got a real head scratcher for you. It's the story of Flexsteel Industries. You see, they just posted what looked like an absolutely killer quarter. But the market? Oh, it hated it. So let's dig in and figure out what the heck happened. So let's start with the good news. And I mean the really good news. Flexsteel's first quarter earnings for fiscal 2026 were just wow. They reported earnings per share of $1.31. The street was only expecting 78 cents. That's a 68% beat. I mean, in this business, that's not just a beat, that's a knockout punch. But, and this is the crazy part, by the time the closing bell rang that same day, the stock had plummeted almost 9%. All that excitement from the earnings beat, gone, vanished. And the trading volume was huge, which tells you people weren't just selling, they were running for the door. So here's the billion-dollar question, right? A blowout quarter, a brutal sell-off. Why? How on earth does a company post its 8th straight quarter of growth and get absolutely hammered by investors? Well, the answer, as it so often is, was hiding in plain sight, right in the middle of their earnings call. Okay, so section 1, the beat, the pop, and the drop. Let's first break down those headline numbers, the ones that looked so good on the surface. And look, it wasn't just some earnings fluke. They beat on revenue, too, pulled in over $110 million when the consensus was closer to 104. So we're talking a solid beat on both the top and bottom line. This wasn't some smoke and mirrors accounting trick. This was pure, solid execution that left Wall Street's estimates in the dust. All right, section 2, anatomy of the blowout. So the question is, how did they do it, especially when they themselves admitted the consumer environment was, quote, choppy? Let's peel back the layers here because, honestly, the way they performed this quarter was pretty darn impressive. I mean, just look at this. This was solid performance across the board, their 8th straight quarter of year-over-year sales growth. They managed to expand their operating margins from 5.8 to 8.1%. That's huge. They kept a tight lid on expenses. And the best part? They did it all while sitting on a pile of cash, almost $39 million, and absolutely zero debt. That's what you call a fortress balance sheet. And you know, the CEO, Derek Schmet, sounded pretty confident on the call, at least at first. He was talking up their growth momentum, their product innovation. You get the picture. Everything sounded fantastic. It was the perfect story, right up until the moment it wasn't. Okay, section 3, a tariff storm gathers. And this is where the wheels came off. Because buried deep in that earnings call, management let a bombshell drop. A huge risk that the market just pounced on, and it completely wiped out all that good news we just talked about. So what was the problem? One word: tariffs. The White House had just issued new Section 232 tariffs, and they were aimed right at imported furniture. For a company like Flexsteel, this wasn't just a little problem. No, this was a full-blown hurricane forming right off the coast. And here's why this was such a game changer. You see, with the old tariffs, Flexsteel had a kind of get-out-of-jail-free card. The stuff they made in their Mexico plants was exempt. Well, not anymore. These new tariffs slammed that door shut. No more exemptions. Everything, whether it came from Asia or Mexico, was going to get hit with a new, higher tariff. And to really understand how bad this is, just look at their business. 90% of what they sell is upholstered furniture. 90%! That means basically their entire product line just got slapped with a future 30% tariff. That is a massive, massive problem. Which brings us to section 4, management's gambit. Because look, investors weren't just freaking out about the tariffs. They were freaking out about how management said they were going to handle it. So, during the Q&A, someone finally asked the big question: what's the plan? And management's answer was interesting. They said they'd pass on about half the cost to customers, raising prices by 15%. But what about the other half? Well, the implication was clear. Flexsteel was just going to eat it. They were going to absorb the other 15%, which is a direct shot to their profit margins. And then the CFO, Mike Ressler, delivered the knockout blow. He announced that because of all this uncertainty, they were pulling all future financial guidance. Just poof, gone. For an investor, that's terrifying. You go from a crystal clear picture of success to staring into a complete black box. So let's get to it. Section 5, the next call, our rating. This is where we have to make a decision. How do you weigh a fantastic quarter against a future that's completely up in the air? It really boils down to this. The bull case is all about their track record. You're betting that this team, which has executed perfectly for 8 straight quarters and has a great balance sheet, will figure it out. The bear case? It's all about the future. Tariffs are coming, margins are going to get squeezed, and even management is saying we have no idea what's going to happen. And for us at Talk Tickers, the bear case wins, hands down. The uncertainty here is just too massive. When a company pulls its guidance completely, it overshadows everything else. That great quarter they just had, it feels like ancient history now. So we're slapping an underperform rating on this one. So that leads us to a potential trade idea. Our thesis is pretty simple. We don't think the full pain of these tariffs is priced in yet. We think that margin crunch is going to be ugly, and we think raising prices is going to hurt demand. So the potential action here? A short position on the stock heading into their next earnings report in February. The bet is that the next quarter's results, and especially their guidance, are going to be rough. Okay, last section. Number 6, the final word. So, what's the big takeaway from all this? What can we learn from the Flexsteel paradox? It's one of the oldest lessons in investing, right? Past performance is no guarantee of future results. The stock market is always looking ahead, through the windshield, not in the rearview mirror. And for Flexsteel, the certainty of a fantastic quarter was completely wiped out by the total uncertainty of what's coming next. And that leaves us with one final thought to chew on. When a company gets hit by a massive external shock like this, something totally out of their control, how much is a great track record really worth? How do you value great execution when the rules of the game have completely changed? And of course, we have to say it, this is not financial advice.